Real Estate Principles, Unit 8, Financing Real Estate. Learning Objectives. When you have completed this unit, you will be able to accomplish the following. Understand the concept of leverage and its role in most real estate purchases. Explain how the various federal agencies help regulate the cost and availability of credit. Identify the documents used in the purchase and financing of real estate. Explain the foreclosure process under a mortgage and deed of trust and how they differ. Identify the lenders who are part of the primary mortgage market. Define common mortgage plans. Explain California's restrictions on mortgage brokers and state and federal disclosure requirements. Key terms: acceleration clause, adjustable rate mortgage arm, adjustable rate note alienation or due on sale clause. American Recovery and Reinvestment Act of 2009 ARA. Amortized loan, annual percentage rate APR, assumption, balloon payment, basis point, beneficiary, California finance lender, California Finance Lenders Law, California Residential Mortgage Lending Act, certificate of discharge, construction loan, credit bid, declaration of default, deed of reconveyance, deficiency judgment, Department of Housing and Urban Development HUD, interest rate, interim loan, joint and several liability, judicial foreclosure, junior lienor, kickback, leverage, loan to value ratio, lock-in clause, mortgage bankers, mortgagee, negative amortization, negotiable instrument, nominal rate, non-amortized, notice of default, notice of trustee's sale, open-ended mortgage, pledged, points, power of sale clause, prime rate, principal, private mortgage insurance PMI promissory note, Real Estate Settlement Procedures Act RESPA, real property loan law, redemption period, Regulation Z, reinstatement, renegotiable rate mortgage RRM, reverse annuity mortgage RAM, right of redemption, right to rescind, satisfaction of mortgage, secure and fair enforcement for Mortgage Licensing Act SAFE Act, purposes of financing real estate. Affordable financing benefits both businesses and consumers. When funds are readily available for borrowing at reasonable terms, businesses can grow and prosper. For individuals, access to financing means the dream of homeownership can become a reality. Across the country, there is almost $12 trillion in loans on 1 to 4 unit residences. It is easy to understand why a homeowner or an investor would want to own property. Real estate has tended to grow in value over the years because of its scarcity and desirability. Real estate values can still be volatile, however, as they reflect the general state of the economy as well as demand for a limited supply of properties. Often the greatest financial benefit of real estate ownership is that it can be used as security for a loan. By borrowing money against the value of the property, home purchasers benefit from present use, and unless property values are stagnant or declining, future appreciation increase in value, and force saving by paying down the amount owed. There may also be tax advantages. Of course, the purchaser who relies on a loan to finance the purchase must have enough income to make the loan payments. But that income generally is far less than the cash that would be needed to buy most property outright. The purchaser thus uses the leverage of a relatively small initial cash outlay to finance purchase of a property worth many times that amount. By reducing the amount of cash that a buyer has at risk, a leveraged purchase can also help protect the buyer if market values go down. Most home purchases would be impossible without the use of leverage. For example, the purchase price of a $500,000 home is being financed by the seller. The buyers will pay $100,000 cash and make a payment of $2,308.95, which includes interest and part of the principal, the balance of the loan, each month. At the end of 30 years, the buyers will own their home outright and will have no further loan payments to make. Some of the most valuable benefits of home ownership are realized when the property is sold, even if it is sold well before the end of the loan term. For example, the buyers in the previous example decide to sell their home after 12 years of ownership. The selling price is $880,000. By that time, the homeowners have paid down the principal of their $400,000 debt by approximately $70,000, but they incur expenses of $50,000 in commission and costs on the sale. So they net $500,000 at the close of escrow. After paying themselves back the initial $100,000 they used for their down payment, the sellers receive a profit of $400,000. They have leveraged $100,000 to make $400,000 cost of credit. A purchaser of real estate who defers part or all of the purchase price uses some form of credit to finance the purchase. When the purchaser receives credit from a lender, the cost of that credit is usually the interest rate charged to the purchaser. The purchaser may borrow money from another source to finance the purchase or borrow money using property already owned outright as collateral. In either case, the cost of those funds typically is expressed as interest. The cost of using money also may include loan fees or points paid at the time of closing, with 1 point equal to 1% of the amount borrowed. Note, when interest rates are quoted by regulatory agencies and financial institutions, they often are expressed as basis points. 1 basis point is 1/100th of 1%, so 25 basis points are the same as 0.25%. Just as there is a market for real estate, there also is a market for the money used to finance real estate. Lenders compete for borrowers by trying to make their loans as attractive as possible. They do so by lowering interest rates and making other loan terms, such as fees and time needed for processing, as attractive as possible. The money supply. Money is a medium of exchange as well as a measure of value. In exchange for our work efforts, we earn income in the form of money. Income also comes from the following: investments, rents, royalties, interest on amounts owed to us. We exchange our income for products and services, invest it, or save it. Income is taxed to provide funds for government to carry out the services it provides. Businesses also receive income and in turn make payments for taxes, salaries, and other costs of production, as well as investments. Factories are built, products are made, and employees are paid. These activities, in turn, pump more money into the economy. The income diverted to taxes is used to buy the goods and services that support government programs. Taxes also subsidize individuals and businesses through a variety of direct and indirect payments. Investment funds and savings provide the capital needed for the industry to grow and prosper. Savings also form the basis of the funds loaned to purchasers and developers of real estate. Savers are paid interest by lending institutions, which in turn charge a higher rate of interest to borrowers of those savings. The federal government is actively involved in the financial marketplace for both commercial and residential loans. Federal Reserve Bank System. The Federal Reserve Bank System, the Fed, was created by Congress in 1913 to serve as the central bank of the United States. The Fed regulates the flow of money and the cost of credit to help stabilize the market fluctuations that create inflation or recession. The 12 regional Federal Reserve banks follow the policies set by a 7-member board of governors. Members of the board are appointed by the President of the United States and confirmed by the Senate for 14-year terms. California, Alaska, Arizona, Hawaii, Idaho, Nevada, Oregon, Utah, and Washington are in the 12th Federal Reserve District, headquartered in San Francisco. Since 1980, even banks that are not members of the Fed have been required to comply with its reserve requirements. When the chairman of the Federal Reserve Board announces a change in the Fed's interest rate, the whole world pays attention. Federal Home Loan Banks. The Federal Home Loan Bank System, FHLB system, was authorized by Congress in 1932. Member institutions, such as federally or state-chartered savings and loan associations, must own capital stock in the regional federal home loan banks, which in turn lend money to member institutions. By 2016, the FHLB system included 7,200 lenders. Federal Deposit Insurance Corporation, The Federal Deposit Insurance Corporation (FDIC) was created by Congress in 1933 to insure individual accounts in participating banks and, as of 1989, savings and loan associations, currently up to $250,000 per depositor per insured bank for each ownership category. Many other federal and state agencies and departments affect the availability and cost of credit. Some of them are discussed in the following paragraphs, and others will be discussed in the next unit. Recent legislation has had far-reaching consequences. Legislation intended to place thrift savings and loan associations on equal footing with commercial banks had some unfortunate consequences, including the failure of many institutions. The Depository Institutions Deregulation and Monetary Control Act of 1980 began the process by greatly expanding the ability of depository institutions to offer services and yields competitive with market rates. The road to FIRREA and the subprime lending crisis. With deregulation came many abuses by thrift associations that were poorly managed. Improperly documented loans, inept or falsified property appraisals, and outright theft of association funds were some abuses that led to the downfall of many institutions. Congress attempted to overhaul the thrift industry by passing the Financial Institutions Reform, Recovery, and Enforcement Act of 1989, FIRREA. FIRREA established the Office of Thrift Supervision and the Federal Housing Finance Board to take over the savings and loan supervisory responsibilities that formerly had belonged to the Federal Home Loan Bank Board (FHLBB). The FDIC was given the additional responsibility of insuring deposits in all federally chartered banks and savings institutions, as well as the bank deposits it already insured. Savings and loan deposits had previously been insured by the Federal Savings and Loan Insurance Corporation (FSLIC), which ceased operation. With one crisis under control, the seeds were sown for another. Continuing low interest rates and relatively easy access to funds inevitably led to the real estate market boom of the first years of the 21st century that also attracted investors who flocked to real estate as a safe haven from the stock market's booms and busts, particularly those involving the technology stocks. Wall Street played a role in the increasingly frenetic real estate market by creating securities based on the value of real estate used as collateral in increasingly risky loans. Many loans required little or no down payment, and borrowers were able to take advantage of no-doc loans in which the borrower's stated income was not verified. Under such market conditions, subprime borrowers, based on their credit histories who formerly would have been denied a loan or offered a loan only at a high interest rate, found ready sources of funds. Low teaser interest rates attracted borrowers who failed to notice or understand the likely future jump in payment amounts when the initial rate period ended. The 2 to 28 adjustable rate mortgage, for example, offered a low rate for the first 2 years of the loan term, followed by an adjustment to the index plus margin rate for the remaining 28 years. Perhaps even scarier were the option arms that allowed a borrower to make a minimal payment, adding part of the interest owed to the remaining loan balance, thus evaporating what little equity might have been built up, and in some cases making the loan balance greater than the market value of the property. When the first of the adjustable subprime loans taken out at the height of the buying frenzy hit the readjustment point in mid-2006, a wave of loan defaults and foreclosures began to sweep across the country, a virtual financial tsunami for the housing market. As the number of properties on the market grew, prices began to fall. Buyers still hesitated to pick up a bargain, in part because there was no way of knowing if the market had reached bottom, but also because of tightening of underwriting criteria by lenders. With fewer clients, many mortgage brokers laid off employees and some closed their doors for good. The subprime lenders and the buyers of the collateralized debt obligations (CDOs) that were backed by real estate assets of greatly diminished value took enormous losses. The crisis showed how far-reaching the residential mortgage market had become when financial institutions in Europe and Asia announced the devastating impacts of the American subprime lending crisis, with losses measured in the billions of dollars. In January 2008, Congress passed the Economic Stimulus Act of 2008 that, among other things, raised the limits on both conforming loans and those insured by FHA. With the prospect of the U.S. government's involvement, it was hoped that the market for the affected loans would stabilize and that borrowers would be able to refinance existing loans and also make new purchases. The Housing and Economic Recovery Act of 2008 (HERA) was signed by President Bush on July 30, 2008. Some of its provisions were modified and additional provisions added by the American Recovery and Reinvestment Act of 2009, signed by President Obama on February 17, 2009. In addition to providing a variety of funding programs to ease the housing crisis, HERA imposed reporting requirements on mortgage brokers to be enacted and enforced by the states. California Senate Bill 36 was signed into law in October 2009 to comply with the Federal Secure and Fair Enforcement for Mortgage Licensing Act SAFE Act, which is part of HERA. The law requires all real estate brokers and salespersons acting under the supervision of a broker who make, arrange, or service loans secured by real property to report that fact to the California Department of Real Estate using Form RE 866, Mortgage Loan Activity. Dodd-Frank Bill. In response to the mortgage lending crisis and subsequent upheaval in financial markets, the Dodd-Frank Wall Street Reform and Consumer Protection Act Financial Stability Act of 2010 was signed into law by President Obama on July 21, 2010. The act created the Financial Stability Oversight Council and the Office of Financial Research, both as part of the Treasury Department. The act also made the Office of Thrift Supervision OTs part of the Office of the Comptroller of the Currency OCC. The merger was completed as of July 21, 2011, and the OTS no longer exists. Appraisals. With FIRREA, the federal government introduced minimum requirements for appraisals as well as appraiser licensing and certification. As of January 1, 1993, a property appraisal in a federally related transaction should be performed only by an appraiser licensed or certified by the state in which the property is located. The type of property and its estimated value determine whether appraiser licensing or certification is necessary. In addition, the appraisal itself must meet or exceed certain minimum standards. Property below a stated minimum value is exempt from the requirements. State requirements can be more stringent but must, at a minimum, meet federal requirements. Real estate as security. Why would anyone lend as much money as most real estate transactions require? Because the loan can be backed by the property. Real estate loans in California generally are made using two instruments. The promissory note is the borrower's promise to pay the amount borrowed. The promissory note is evidence of the debt. It establishes the underlying obligation of the loan transaction. In other words, the promissory note is the borrower's IOU to the lender. The security instrument is used to identify the real estate that serves as assurance that the loan will be repaid. With a security instrument, a property owner hypothecates the described real estate. Hypothecation means the real property will be forfeited to the holder of the security instrument if the underlying debt is not paid. Usury is the charging of an exorbitant amount or rate of interest and is the subject of both state and federal law. State law. In 1979, California voters passed Proposition 2, which exempted from usury laws any loan made or arranged by a real estate broker and secured by real property. California law also exempts loans made by banks and savings and loan associations. Loans of credit unions, personal finance companies, and pawnbrokers are exempt unless the loan falls in one of the statutory categories mentioned below. The maximum statutory interest rate that may be charged for consumer loans, money, goods, or other things intended for personal, family, or household purposes other than loans for the purchase, construction, or improvement of real property is 10% per year. Money, goods, or other things intended for the purchase, construction, or improvement of real property are subject to a maximum rate of 10% or the prevailing Federal Reserve Bank discount rate plus 5%, whichever is higher. Business loans are subject to a ceiling of the Federal Reserve Bank discount rate plus 5%. The refinancing of a loan is subject to the same maximum rate as the original loan. Federal law. When they cover the same subject, federal law preempts state law. Federal law exempts federally related residential first mortgage loans made after March 31, 1980 from state interest limitations. This includes loans used to finance manufactured housing mobile homes and the acquisition of stock in a cooperative housing corporation. The federal act effectively limits the California usury laws to private lenders. Seller financing. When a seller of real property extends credit for part or all of the purchase price, it is not considered a loan for purposes of the usury laws, but merely an extension of credit. The seller must act in good faith, however, or the transaction can be questioned. The process of hypothecation is similar to what occurs when personal property is pledged to secure payment of a loan. One important difference is that with a pledge, possession of the pledged property is turned over to the lender until the debt is paid. Think of the jewelry on display in a pawn shop window. The borrower typically retains possession of hypothecated real property, making it possible to enjoy the benefits of property ownership even when property is heavily mortgaged. The security instrument is what is commonly referred to as a mortgage. As you will learn, however, the legal document that serves as the security instrument can take the form of either a mortgage or a deed of trust with very different results. Promissory note. The promissory note is a promise to pay money according to specified terms. The payment may be by installments that include both interest and principal, the amortized loan, or by installments of interest only with the principal due in a lump sum, a straight note. A combination of loan types also may be used, with a lump sum balloon payment due at the end of a specified term, during which only part of the principal is paid. A balloon payment is defined by the real estate law as an installment that is at least twice the amount of the smallest installment. Interest rates are allowed to reflect market trends by use of an adjustable rate note, described later in this unit. A loan can also call for payment of the entire amount due on demand of the holder of the note. Joint and several liability. When more than one person signs a promissory note, there will probably be language in the note such as the phrase jointly and severally, indicating that each cosigner is liable for the entire financial obligation imposed by the note. This joint and several liability means that if one cosigner defaults in payment on the note holder can demand full payment from any other cosigner. Obviously, careful consideration should be given to any request to serve as cosigner on a note or other financial obligation. Cosigning a note also will affect the cosigner's credit record. Negotiable instrument. To qualify as a negotiable instrument, a promissory note must be an unconditional promise made by one person to another in writing. An agreement to pay a specified amount of money on demand or at a fixed or determinable future time. A payable on the order of a designated person or the bearer of the note and assigned by its maker. Installment note interest. Security instrument. The security instrument hypothecates the property that serves as the lender's assurance that the underlying debt will be repaid. The process of hypothecation, as described earlier, is similar to a pledge, but the property owner retains possession of the property. The security instrument is commonly referred to as a mortgage, although it may take one of several forms, only one of which technically is a mortgage. It is not commonly used in California, even though the mortgage was the first security instrument used in the state. The deed of trust now is the preferred security instrument in California. Whether it takes the form of a mortgage or deed of trust, the security instrument will be recorded to provide constructive notice of the lien rights of the lender. A mortgage is an instrument by which property is hypothecated to secure the payment of a debt or an obligation. A lien on the property is given by the mortgagor, borrower, and property owner to the mortgagee lender. In the event of the mortgagor default before final payment, the mortgagee's remedy is judicial court-ordered foreclosure. As an alternative, the mortgage instrument could contain a power of sale provision that allows a non-judicial foreclosure. A mortgage with a power of sale clause thus operates in the same way as a trust deed does when property is sold at a trustee's sale, discussed later in this unit. The current procedure for judicial foreclosure took effect on July 1, 1983. In a judicial foreclosure, the court orders the property sold to the highest bidder at public auction in the county where at least part of the property is located. The court appoints a commissioner or orders the sheriff to carry out the sale. Statutory notice requirements must be met. Anti-deficiency, the Homeowners Safety Net California Code of Civil Procedure 580B. As long as market demand exceeds supply and prices continue to rise, California homeowners usually don't need to worry about foreclosure. Even when an individual has difficulty making loan payments, the sale of the property will relieve the owner of the payment burden and most likely will provide a profit over the purchase price. But what happens when the market takes a turn for the worse? And what about the worst case scenario? The current market value of the property is less than the remaining loan balance. That's when California's anti-deficiency protection provides the ultimate safety net for homeowners. If a homeowner can no longer continue to make payments on a loan secured by a mortgage or deed of trust on the home, the only recourse for the lender is to take back the property. Even if the current market value of the property is less than the outstanding loan balance, the lender cannot seek a judgment against the defaulting homeowner for the difference. A deed of trust. The deed of trust is the security instrument preferred by lenders who make loans on California real estate for a simple reason: if the borrower defaults on a loan secured by a deed of trust, the foreclosure is typically faster and less expensive for the lender than a mortgage foreclosure. A deed of trust or trust deed is an instrument by which real property is hypothecated to secure payment of a debt or an obligation. The title to the property is transferred by the trustor owner and borrower to the trustee and neutral third party to hold on behalf of the beneficiary lender until the debt is repaid, even though the borrower retains possession. In the event the trustor defaults on the underlying debt, the trustee is instructed to sell the property and transfer the money obtained at the sale to the beneficiary as payment of the debt. The form of notice of default became effective June 1st, 1985. The first statement in the notice must be printed in bold type. The notice must be in Spanish if the trustor so requested, or if the contract was negotiated in Spanish. The beneficiary or trustee must state that the entire debt is due because of the default, or it cannot be collected at the sale. Short form deed of trust and assignment of rents show net. The notice of default is sent by registered or certified mail to the trustor, any successor in interest to the trustor, junior lien holders, the state controller if there is a tax lien on the property, and anyone who has filed a request for notice with the county recorder. If any parties other than the original trustor are involved, notice is also published in a newspaper of general circulation once a week for 4 weeks. The California Foreclosure Prevention Act extended the waiting period between filing of the notice of default and filing of the subsequent notice of sale from 90 days to 180 days, effective June 15, 2009, but the Act exempts from the extension lenders with comprehensive loan modification programs. Notice must be made to the borrower at least 20 days before a foreclosure sale by mail to the defaulting borrower, as well as by posting at the property that is the subject of the foreclosure and in a public place in the county where the sale is to occur. A debt under a trust deed or mortgage can be reinstated if payment of the overdue amount is made at any time after the notice of default is recorded, but no later than 5 business days before the date of sale. Postponement of the trustee's sale. If no acceptable bid is received, or if more than one sale has been scheduled for the same time, the trustee's sale can be postponed. Postponement of the sale revives the right of reinstatement as of the date the new notice of sale is recorded, and it continues until 5 business days before the new date of sale. The same rule applies to any further postponement. There is no limitation on the number of postponements, but if the sale does not occur within 365 days of the notice of sale, a new notice of sale must be given before any further sale proceedings may be scheduled. The most significant difference between a mortgage and a trust deed or mortgage with power of sale is that there is no right of redemption following a trustee's sale. The sale is absolutely final, and the purchaser can take possession immediately. A bidder at such a sale will understandably be willing to offer a higher price than if the sale were a judicial foreclosure. Being entitled to possession is small comfort to the purchaser if the former owner refuses to vacate the premises. An unlawful detainer is the legal action by which the court orders the sheriff to evict the present occupant. The purchaser at a trustee's sale must also take such an eventuality into account. Deed in lieu of foreclosure. A deed in lieu instead of foreclosure may be used to transfer property to the beneficiary of a trust deed with the beneficiary's consent to prevent a forced sale. Transfer of the property to the beneficiary may be to the beneficiary's advantage if the property is worth at least the amount of the remaining debt. The trustor benefits by avoiding the publicity of a public foreclosure sale. A danger arises when the property is worth more than the outstanding debt owed to the beneficiary. In that case, the beneficiary should pay the difference to the trustor, or the transfer could be challenged later in court. A deed from borrower to lender under a trust deed also makes the deed subject to any liens that were incurred after the borrower issued a deed to the trustee to secure the loan. A transfer from trustee to lender in foreclosure transfers a title that is good as of the original transfer, when a mortgage is really a deed of trust. The term mortgage is used generically to refer to any security device. In California, that device instrument most often takes the form of a deed of trust. The trustor, borrower, trustee, third party holding title, and beneficiary lender are the parties involved in a deed of trust. When we refer to a mortgage in the rest of this in the next unit, however, we will mean any real property security instrument. By mortgagor, we will mean the borrower under any form of security instrument, and by mortgagee, we will mean the lender under any form of security instrument. In the same way, the term foreclosure most often means a trustee's sale. The use of what may appear to be the wrong terminology simply is recognition of the fact that for most of the country, those are the correct terms. UNRRA Act mortgages and deeds of trust. California's UNRRA Civil Rights Act covers contracts for goods and services. If a mortgage with a power of sale clause or deed of trust on a single-family owner-occupied residence stems from a contract that falls within the UNRRA Act, even more explicit notice must be given to a truster or mortgagor in default. The Act also prohibits discriminatory language in real property instruments for the purpose of restricting the conveyance, encumbrance, lease, mortgage, use, or occupation of property. The object of this special provision is to prevent a homeowner from unwittingly losing the home as the result of a retail installment purchase. The requirements for imposing a mortgage or deed of trust, as well as the requirements on default, can be found in the Civil Code. Home equity sales contracts. The high rate of overall property appreciation in recent decades greatly increased the equity of owners of real estate throughout the state. Increased equity has made properties attractive to unscrupulous individuals seeking to take advantage of homeowners whose property is in foreclosure. By use of a home equity sales contract, the property owner in foreclosure may be persuaded to sell the equity in a home for far less than its true value. The problem became severe enough to warrant legislation now included in the Civil Code. The law provides the following. A home equity sales contract must be in letters equal to 10-point bold type. This sentence is printed in 10-point bold type. The contract must include notices of the equity seller's right of cancellation. The contract may be canceled by the equity seller at any time up to midnight of the 5th business day following the contract signing or 8 a.m. on the day set for sale under a deed of trust, whichever comes first. Other foreclosure abuses. The California Civil Code also covers the abuses of mortgage foreclosure consultants. In Section 2945A, the legislature states that homeowners whose residences are in foreclosure are subject to fraud, deception, harassment, and unfair dealing by foreclosure consultants. To combat these practices, the law specifies notice and other requirements that must be scrupulously followed by anyone other than those exempted from the provision who offers to stop or postpone a foreclosure sale, assist in obtaining a loan or an extension for payment, or perform other activities involving property in foreclosure. Abuses by mortgage foreclosure consultants are taken very seriously. Violation of the law could result in both civil and criminal penalties, including fine, imprisonment, or both. Real estate lenders, the primary mortgage market. Lenders who initiate loans with borrowers are part of what is called the primary mortgage market. There are both institutional and non-institutional lenders in the primary mortgage market. Institutional lenders. Institutional lenders make most of the loans used by home and business owners. Depository institutions include those that lend money for the purchase or refinancing of real estate or for the construction of improvements. Such institutions act as intermediaries between the borrowers and the sources of the funds the institution has available to lend. As discussed previously, those funds are typically savings or investments. Loan-to-value ratio and PMI. The loan-to-value ratio is the percentage of the current appraised market value represented by the amount of said loan. In other words, what percentage of the value does the loan represent? If the loan-to-value ratio exceeds 80%, the borrower must obtain insurance for the loan amount over 80%. Private mortgage insurance PMI, typically added to the monthly loan payment, will automatically be discontinued after the loan has been paid down to 78% of the original sales price, as required by the Federal Homeowners Protection Act of 1998 HPA. The borrower has the right to request cancellation of PMI when the loan balance is no more than 80% of the original purchase price or appraised value at the time of purchase, whichever is less. Home loan payment terms may be described as fully amortized equal payments including both interest and principal are made over the loan term. Partially amortized, most of the principal remains to be paid in the last payment. Non-amortized, the straight note, typically interest only, with the entire amount of principal due at the end of the loan term or as having. Negative amortization loan payments do not cover all of the interest due, which is then added to the remaining loan balance. Commercial banks. All banks must be members of the Federal Reserve System. The National Bank Act covers national banks. The California banking law covers state banks. Banks make the greatest number of different types of loans. There are no restrictions on loan-to-value ratios or amortization schedules or limitations on the amount of funds that can be loaned on real estate by national banks. This is one reason why this form of institution is becoming increasingly popular. Commercial banks are supervised by the U.S. Controller of the Currency. Insurance companies. With the exception of single-family homes, insurance companies invest in most types of real estate by making mortgage loans. Insurance companies are governed by the laws of the state of their incorporation as well as by the laws of the state in which they do business. Insurance companies typically finance large commercial projects, but also buy loans from mortgage companies discussed later in this unit and invest in government-insured or guaranteed loans. Mutual savings banks. A mutual savings and loan association distributes its earnings to depositors after providing for expenses, reserves, and other costs of operation as dividends rather than interest. Originally found in the New England states and relatively new to California, both mutual and stock savings and loan associations have reformed as mutual savings banks. They can retain federal deposit insurance and follow federal regulations. They can also be state chartered. Commercial banks make the broadest range of loans, including those for real estate purchase, construction, and interim financing before a building under construction is completed, and even consumer loans for home improvements. Commercial banks also make many business and short-term credit loans, including automobile financing. Bank credit cards represent a growing portion of commercial banks' activity. Credit unions of growing importance are the loan-making functions of credit unions, which are organized under the National Credit Union Administration, a federal agency. Credit unions receive the savings of members, frequently through payroll deductions, which they use to make loans to members. Loans may be unsecured, but more often are secured by a home, an automobile, a boat, or other asset purchased. Credit unions typically have relatively low overhead expenses. As a result, many credit unions can offer loans at competitive interest rates while also offering interest rates on savings accounts and other investments that may be better than those offered by commercial banks in savings and loans. Participation is restricted to the defined group of prospective members, such as federal employees. Non-institutional lenders. Non-institutional lenders include mortgage companies, private individuals, and organizations that are not financial institutions. Mortgage companies. Mortgage companies or mortgage bankers make real estate loans, then sell those loans to investors. The mortgage company will service the loans it has sold on a contractual basis. Servicing a loan includes receiving payments on behalf of the investor and otherwise handling the day-to-day supervision of the investment. Mortgage companies are a prime source of government-insured and guaranteed loan funds as well as conventional loans that do not involve government cooperation. State laws regarding mortgage companies historically have been much broader than those governing banks and SLS. Many mortgage companies invest their own funds or borrow investment funds themselves from commercial banks. Private individuals. Non-financial institutions and private individuals hold 1/4 of all mortgage debt. Private individuals are the largest source of second mortgage funds junior loans. When the lender is an individual rather than a bank or mortgage company, there won't be a loan committee or arduous qualification process. In addition, an individual may offer lower loan costs and a better interest rate. When individuals make direct loans as opposed to extending purchase money credit, they are subject to the usury laws unless a broker has arranged the loan. Non-financial institutions. Real estate loans make up some of the most important assets of non-financial institutions. These include pension funds, colleges and universities, trusts, estates, mortgage investment companies, and other groups. As with individuals, non-financial institutions may make fewer demands in terms of borrower qualifications. Such investors are also unlikely to be part of the primary mortgage market for single-family homes. Mortgage loan brokers. California's real property loan law, part of the real estate law and found in Article 7 of the Business and Professions Code, allows a real estate broker to solicit borrowers or lenders or negotiate loans for real property. The real property loan law applies to loans secured by equity in real property, but it does not apply to purchase money loans. Put another way, the law applies to hard money cash out as opposed to soft money loans, those used to buy the property. A broker can loan his own funds if the borrower is informed of the source of the funds. If funds from a family member of the broker are loaned, the relationship also must be disclosed. Other restrictions on mortgage loan brokers. There are other restrictions on loans made by brokers that are not greater than $30,000 for a first mortgage or $20,000 for a second mortgage. They include the following: no balloon payment a payment more than twice the amount of the smallest. Payment is required on an owner-occupied dwelling if the loan term is less than 6 years, 3 years for property not owner-occupied unless the loan is taken back by the seller as part of the purchase price. No borrower-paid loan servicing or loan collection fees are assessed. Borrower may not be required to obtain credit life or disability insurance as a loan condition. If the broker provides such insurance, only one premium may be collected, and only a borrower who might be expected to contribute to loan payments such as a wage earner may be insured. California Residential Mortgage Lending Act. Some lending activities are conducted under the rules of the California Residential Mortgage Lending Act. The law applies to those involved in making or servicing mortgage loans on 1 to 4 family dwellings. Government, such as banks, savings and loan associations, trust companies, and insurance companies, or an individual or company making residential mortgage loans with his, her, or its own money. Government and pension plan employees. Court-appointed estate or other representatives. As a trustee under a deed of trust. The law also exempts a California finance lender licensed under the California Finance Lenders Law. A finance lender is someone who is in the business of making consumer loans or commercial loans in which personal property may be used as collateral. Federal disclosure requirements. What is TRID? The RESPA Integrated Disclosure Rule TRID consolidates 4 disclosures required under the Truth in Lending Act and the Real Estate Settlement Procedures Act RESPA for closed-end credit transactions secured by real property. There are now 2 forms of loan estimate that must be delivered or placed in the mail no later than the 3rd business day after receiving the consumer's application, and a closing disclosure that must be provided to the consumer at least 3 business days before consummation. These forms reveal the true cost of a loan in a way that the average borrower can understand. What transactions does TRID cover? TRID applies to most closed-end consumer credit transactions secured by real property. It does not apply to HELOCs, reverse mortgages, or chattel dwelling loans, such as loans secured by a mobile home or by a dwelling that is not attached to real property land. Consistent with the current rules under TILA, the rule also does not apply to loans made by a person or an entity that makes 5 or fewer mortgages in a calendar year. What are the trade record retention requirements? The creditor must retain copies of the closing disclosure for 5 years after consummation. For evidence of compliance with the integrated disclosure provisions of Regulation Z, including the loan estimate, creditors must maintain records for 3 years after consummation of the transaction. A business day is any day except Sundays and federal holidays. Some state-chartered lenders also recognize state holidays. What are the general requirements for the loan estimate? For closed-end credit transactions secured by real property other than reverse mortgages, the creditor must provide the consumer with good faith estimates of credit costs and transaction terms on a new form called the loan estimate. The creditor is generally required to provide the loan estimate within 3 business days of the receipt of the consumer's loan application. The loan estimate must also be delivered or placed in the mail no later than the 7th business day before consummation of the transaction. The consumer may modify or waive the 7 business day waiting period after receiving the loan estimate if the consumer has a bona fide personal financial emergency that necessitates consummating the credit transaction before the end of the waiting period. New 3-day waiting period. If the creditor provides a corrected disclosure, it may also be required to provide the consumer with an additional 3 business day waiting period before consummation of the transaction. May a consumer waive the 3 business day waiting period? Yes, but the creditor is prohibited from providing the consumer with a pre-printed waiver form. Like the 7 business day waiting period after receiving the loan estimate, consumers may waive or modify the 3 business day waiting period when The extension of credit is needed to meet a bona fide personal financial emergency. The consumer has received the closing disclosure, and the consumer gives the creditor a dated written statement that describes the emergency, specifically modifies or waives the waiting period, and bears the signature of all consumers who are primarily liable on the legal obligation. The creditor is prohibited from providing the consumer with a preprinted waiver form. When must the settlement agent provide the closing disclosure to the seller? The settlement agent must provide the seller its copy of the closing disclosure no later than the day of consummation. Does TRID require any other new disclosures? In addition to the disclosures discussed above, TRID also changes some other post-consummation disclosures provided to consumers by creditors and servicers, the escrow closing notice and mortgage servicing transfer and partial payment notices. For loans subject to the escrow closing notice requirement, the creditor or servicer must provide consumers with a notice no later than 3 business days before the consumer's escrow account is canceled. The escrow closing notice must be provided before canceling an escrow account to any consumers for whom an escrow account was established in connection with a closed-end consumer credit transaction secured by a first lien on real property or a dwelling, except for reverse mortgages. Impound accounts. The lender may require that an impound account, also known as a mortgage escrow impound account, be established for the benefit of the borrower to accumulate reserves for future recurring costs, such as property taxes and hazard insurance. The borrower's mortgage payments will be increased to cover contributions to the impound account, which is held in trust for the borrower's benefit by the lender. An impound account may be required by a lender in California as a condition of loan approval on a loan secured by a single-family owner-occupied dwelling, only when the loan amount is 90% or more of property value, combined loan amounts exceed 80% of property value. It is required by a state or federal regulatory authority. The loan is made, guaranteed, or insured by a state or federal governmental lending or insuring agency. A kickback is an illegal fee paid by a non-licensee such as a loan officer to a salesperson or broker. The lender is not allowed to charge a fee for preparation or distribution of TRID documents. The lender is also prohibited from paying a fee, kickback, rebate, or other thing of value to any person who does not provide loan services. The same prohibitions also apply to title and escrow companies. Examples of loan services that may be compensated include counseling the borrower, comparing borrower housing needs with available mortgage loans, and keying information into a computerized loan origination system. Consumer communications. The Consumer Financial Protection Bureau CFPB, created by the Dodd-Frank Act, issued mortgage disclosure rules. The latest revision took effect June 1, 2018. A consumer information pamphlet must be provided to the borrower. The pamphlet explains the information that the lender must provide to the borrower and also explains how the borrower can initiate a complaint if the lender is not following the rules. The lender must provide billing information in writing, give the borrower 2 months warning if an adjustable rate mortgage will have a rate change, promptly credit the borrower's payments, respond quickly when the borrower asks about paying off the loan, not charge for insurance the borrower doesn't need or overcharge for insurance the lender provides if the borrower fails to do so force-placed insurance. Quickly resolve complaints, generally within 30 to 45 business days, and share information. Contact the borrower to help if the borrower is having trouble making payments and work with the borrower before starting or continuing foreclosure, and allow the borrower to seek review of the decision about a loan workout request, loan assumptions and subject to. When property is sold or transferred, the existing loan may be paid off by the seller or assumed by the new owner if the loan agreement allows. Another possibility is for the property to be taken subject to the loan if the loan agreement allows. In a loan assumption, the new borrower is substituted for the old borrower, the seller, releasing the seller from further obligation under the note. If a property is taken subject to the note, the seller will technically still be liable for the remaining indebtedness. If the buyer defaults, the lender can look to the seller, the former owner, for payment. Taking possession subject to an existing loan benefits the buyer, who cannot be held liable for any deficiency judgment that might stem from a default on the loan. Loan costs are usually lower than what would be paid to obtain a new loan. Loan assignment. The Helping Families Save Their Homes Act amended TILA in 2009 by requiring that consumers be notified of the sale or transfer of their mortgage loans. The party acquiring the loan, whether a purchaser or assignee, must provide the required disclosures no later than 30 days after the date on which the loan was acquired. Acceleration and due on sale clause. Most mortgages and trust deeds contain a provision that allows the lender to declare the remaining indebtedness due and payable on the happening of certain conditions. The loan can be called the lender can demand full payment if the borrower defaults by missing a payment, failing to pay taxes, committing waste by failing to maintain the property that is used for security, using the property for an illegal purpose. An acceleration clause may also be put into effect when the borrower relinquishes possession of the secured property by sale or transfer, preventing an assumption by a new owner. Use of such an alienation or due on sale clause has been the subject of much case law and legislation. At present, due on sale clauses are enforceable. Construction lending. The length and expense of the housing development process has resulted in several types of specialized loans. A construction loan, also called an interim loan, is one made to finance building construction or other improvements to land. Loan funds are usually made available to the builder in increments as the construction progresses. The builder may arrange for permanent financing for the property buyer in the form of a takeout loan for the buyer. The proceeds of the takeout loan are used to pay off the builder's construction loan. To ensure that funds are available for prospective purchasers of the completed properties, a mortgage banker may make a standby commitment to a builder, agreeing to make mortgage loans at a stated price for a future time. The builder pays a standby fee for this privilege, the loan application. The Uniform Residential Loan Application Form 1003 typically is used to qualify a prospective borrower purchasing a single-family residence. Form 1003 was prepared by Freddie and Fannie Mae, which are discussed in the next unit. Use of a carefully drafted form helps ensure that the Federal Equal Credit Opportunity Act is not violated. That act prohibits discrimination based on age, sex, race, color, marital status, religion, or national origin. All applicants must be considered in light of their income, the stability of the source of that income, total assets and liabilities, and their credit rating. The three major credit reporting agencies are Equifax, Experian, and TransUnion. Several companies have created methods of analyzing a borrower's credit reports to produce a credit score. One of these companies is FICO, formerly the Fair Isaac Corporation, headquartered in San Rafael, California, which produces a credit rating known as the FICO score. A borrower whose FICO score is in the highest range will be able to obtain financing at a lower interest rate than someone who has a FICO score in a lower range. Someone with a FICO score in the range of 760 to 850 is considered an excellent credit risk. An individual with a score below 620 is considered a very poor risk and will pay a much higher interest rate, assuming a loan can be obtained. If a loan is rejected, the Federal Fair Credit Reporting Act, FCRA, and state law require that the lender provide a statement to the loan applicant within 30 days detailing the reasons for the refusal. The loan applicant also has the right to a free copy of any credit report that was considered in the loan application process. The loan application usually follows an interview with a loan officer of the lending institution. The interview is useful in explaining the loan procedure and initially qualifying the loan applicant. The next step is the loan officer's analysis, which includes the property being considered for purchase. An appraisal is made to ensure that the property will provide good security for the amount borrowed. After the loan is approved, the necessary paperwork and funding are usually handled through an escrow agent who makes sure that all parties have fulfilled their obligations before the transaction is closed, combating mortgage fraud. The Fraud Enforcement and Recovery Act of 2009 provides federal authorities with expanded legal powers against individuals and mortgage operations that previously have only been overseen at the state or local levels. The law has created a Financial Crisis Inquiry Commission with broad powers to investigate such topics as the subprime boom, Wall Street influence, and bank failures.